It's a pleasure to be here. Thank you, Professor Athanasakos, Greg, for the introduction, Ali for all her hard work and help getting me here with the itinerary and everything. But I really appreciate the opportunity to be here. I want to talk a little bit about investing, about education, and then I want you to fire away with any questions that you may have. And afterwards, Ali has my email, and so does the professor. If there's anything I can ever do to help you, feel free to email me, and I'd love to try and help in some way. What I wanted to do initially is to start, I wanted to talk about the skills to develop as a student regarding some of my thoughts and things that I think are really important for all of you to try to embrace and understand, independent of investing, to really prepare you better for the work world. And I think, education is really important, but education gives you the foundation, but you also need the practical application. So the theoretical world is great, but the real world is very different, and I think you need a combination of the two. And so the first is really, and it's really hard, some of these take time, learn to listen in a focused and active way. Most of the time when you talk to people, they're really thinking about what they want to say rather than really sitting down and listening in a focused and active way to what you're saying. Second, build relationships everywhere. You never know the value of a relationship, so build relationships everywhere you go. Interpersonal skills are critical. Be likable and be respected. And you'll find in your career, your analytical and technical skills are really important, but your technical skills can be purchased. Your ability to get along well with others is actually more important than your technical skills. Fourth, develop your analytical skills. Critical thinking. Left brain is deductive, rational, objective, while the right brain's inductive, intuitive, and emotional intelligence. You really want to develop both sets of those skills, because what you'll find is a lot of people are really good at one or the other. There's people that are really good analytically and people that are really good on the interpersonal selling side. The reality is you want to be able to do both. And if you can do both, it will really enable you to do almost whatever you want with your life. Most people are only good at one or the other. Develop your communication skills, both verbal and written. We have 4 kids, and our youngest is 22. And I just have to tell you, the verbal and written communication skills now are nothing like they were 20 and 30 years ago. It's text messages that I can't even read. So it's really important to develop your communication skills, both verbal and written. And years ago when the iPhones came out, our youngster, I think my plan, I used to do like 5 text messages a month. And I think my wife told me, because he was on her plan, I think he did like 5,000 in a month. So that's kind of what, got me interested in this texting business. 6, follow your dreams and goals and be flexible in your pursuit of them. Adaptability is the key. Really, one of the things I try to do is always begin with the end in mind. What do you think you want to do? And then work backwards. I think I want to do this. Well, who's done it and been successful? See what they've done and kind of do it backwards. So begin with the end in mind. It's really important. Happiness, the quality of your life depends upon the quality of the relationships you develop, both professionally and personally. Just think about it. People go to work every day with people they really don't like. People are married to people they really don't like. Think about it. The quality of your life is really going to be driven by the quality of your relationships, both personally and professionally. And I raise that because even though I love investing and it's a huge part of my life, you should also spend time focusing on your personal life as well. Whatever it is, I don't care what your choices are, but think about it. I have so many friends and people that I've known in New York and elsewhere, they're focused all their energy and everything on their professional career, and they've really missed out on the personal side. They wake up at 40 or 50, they're very successful financially, but they really, really are unhappy on the personal side. So the same focus you apply professionally, also think about personally and focus on it. I like Mark Twain's quote, which I really believe in. It's really important. Keep away from people who try to belittle your ambition. Small people always do that, but the really great people make you feel that you too can become great. Never, ever let anyone diminish you. I think it was Eleanor Roosevelt said that no one can make you feel inferior without your permission. There's a lot of people out there that are not of the highest quality. If you really believe in something and want to do it, you really follow through on it and don't compromise. It's really, really important. And it also applies to a lot of the young ladies in here. I'm very sensitive to this because I grew up with 3 older sisters. So I have to really defend. I lecture at Alabama, and they have a group there called the Culverhouse Investment Management Group. And when I started going, there were 40 students and 2 girls. So every year, when I go down there, they come running up and tell me how many more girls there are in it so I don't yell at them. But again, really focus on your goals and dreams and follow through on them. Small minds discuss people, average minds discuss events, great minds discuss ideas. Ideas is really what life is all about, really thinking about things creatively and generating ideas. That's where you should spend your time. Only a life lived for others is a life worthwhile. It's really important. I mean, just think about it. How many people have you helped? How many people have you tried to impact their life positively? It's really fulfilling, and it's a way that people really live on after they're gone. Something to think about. And you're young now, but as you get older, it becomes even more important, and I hope you feel it's important. Excellence versus success. There are many people, particularly in sports, who think that success and excellence are the same thing. They're not. Excellence is something that's lasting, dependable, and largely within your control. In contrast, success is perishable and is often outside of your control. If you strive for excellence, you'll probably be successful eventually. People who place excellence first have the patience to end up with success. It's really, really important. Again, focus on trying to do the best that you can do. And for example, in the business world, people that make enormous fortunes, the reality is they've worked very, very hard. They're creative. They're visionary. They took enormous risks. But at the end of the day, to really make enormous amounts of money, hundreds of millions and billions, what you need is a confluence of factors that come together simultaneously. And what I'm referring to is a lot of that really is luck and outside of your control. There's a lot of people that work hard, but not everyone becomes a Bezos or a Bill Gates or whatever. So you also have to get lucky. And a lot of things that you can't control have to come together to create that situation. Finally, I just wanted to talk about building a business real quickly. Some of the founding principles, some of the things we think about in building our firm. When we look at long-term employees, whenever we interview someone, it's really hard when you're interviewing someone. You don't know these people. Even when you do background checks or when you call for references, you just don't know people. You don't know what's inside people. So some of the things I think about when we interview people to work at our firm, and we've had virtually no turnover. Tina's with me almost 18 years. Mike Allman's been with me a long time. The things we ask are things related to, are you trustworthy? Can I trust you? Because at the end of the day, trust is the foundation of every relationship. Without trust, nothing really matters. The second thing is, do you care about me and my family and our firm? How committed are they? Are they people that really care about you and your family, and vice versa? It's got to be reciprocal. And the third is, are you committed to excellence? You want people that really care about being good at what they do. And that really comes from inside. You can't really teach that. Some people have it and some don't. And then some of the founding principles within the firm. Teamwork is highly prized and recognized because it maximizes many individual contributions. The reality today, the world is really, really tough. And teams, people that can build great teams are really what build great organizations. The day of the individualist is over. You really don't accomplish much on your own. It's the ability to have a vision, communicate that vision, have sound judgment, and get other people to follow what you're doing. An open culture that's a true meritocracy is our ultimate organizational goal, really important. Encouraging dissent leads to an open culture. Respectful communication is the foundation for a successful work atmosphere and culture. In our business in investing, and it applies throughout life, whenever I generate an idea or anyone generates idea, we try to shoot holes through it. And the smarter the people that you talk to, I don't care where the idea comes from. I could care less. And a lot of people in this business don't operate that way. They want it to be their idea. I could care less. If it's a really good idea, the question is it the best idea? And is it a great idea for our clients? That's all that matters. I don't care where it comes from. So frequently when we do ideas, we have devil's advocate and we try to get others to really beat up on the idea. And what's important here is in organizations, and as you get bigger, you don't want that process to become political where people are attacking each other. You want them to attack the idea, not one another. It's a big, big distinction. because bonuses get involved, salaries get involved, roles, titles. It's just all nonsense. The reality is, what's the best idea? Responsible freedom provides the opportunity for individuals to achieve success according to their initiative and maturity. It's really a premise of inherent trust. And a great example of that is our team is all based in Wyomissing, Pennsylvania, which is about 60 miles northwest of Philadelphia. Me and another analyst on our team live in New York City. So Tina sees me 7 times a year. That's it. She's 125 miles away. I never see Tina. I talk to her all the time. The point I'm making is you have to fundamentally trust each other. I don't micromanage. I'm never there. She never sees me. It's probably good for her. But the point I'm making is you really have to build unique relationships with people to do this. Now, I would also add I worked with her there for several years before I moved to New York. It'd be very difficult to have that kind of a relationship if I just hired someone. I mean, she knows how I think. She knows all that. And same with Mike and the rest of the team. Hierarchy should be de-emphasized to spawn creativity. I don't care about titles. I don't care about any of that stuff. It's all nonsense. You really want a creative environment. I hate hierarchy. You know, you create your environment in your own way, and as long as you're all aligned together, you can really build a great team together. The client comes first in all we do. It's the focus in all we do. Research, performance, and service, that's really what drives us. We wouldn't have a business without them. And people need the opportunity to fail. The ability to fail is one of the greatest gifts available to us all. Learn from it and move on. You're all going to make mistakes. I can't tell you the number of mistakes I've made in investing. It's too depressing. Most of my mistakes in investing have not been mistakes of commission. They've been mistakes of omission. And when I say omission, I don't mean that a stock went from 10 to 300 that I didn't look at or didn't understand. I mean you do the work and you do the analysis, and for whatever reason, you don't step up to the plate and have the courage to make the investment. That's happened many, many times. And looking back, it's easy in hindsight. It's very easy in hindsight. I played quarterback in high school. It's so easy to second guess. It's hard to look to the future and be right. So those are just some points I wanted to bring up for you. I sent 2 presentations to Allie that I did several years ago, and I just wanted to talk about them briefly. One is a 60 or 70 page PowerPoint slide presentation on Unitedhealth. I did it January of 13. The other one is on Zoetis. I did July of 14, and that's 120, 130 pages. I don't want to waste your time and go through slides. And so what I want to do is just summarize off the top of my head a couple of the key points in terms of these companies. These were both terrific investments I made, and I can talk about lots of my failures afterwards. You can ask questions and I can talk about them. But the first was Unitedhealth. Now, I don't know, how many people in here know who Unitedhealth is? Okay, great. It's a managed care company, Cigna, Aetna, WellPoint, acquired by Anthem. They're an HMO. They started as an HMO. I started studying it back in 1989, 1990. I met Bill McGuire. Now, here's what was unique, and I'm going to talk a little bit about differential insights and doing field-based research. I'm not smart enough to sit in an office and just do analytical calculations and figure out what to buy. We spend an enormous amount of time going out in the field talking to competitors, customers, high-level former employees, vendors, et cetera, to really confirm the numbers. Because when you think about it, the numbers really tell you the past. And we can do all kinds of screens, and that's great. Returns on invested capital, leverage, we can do all that. A lot of people can do that. The question is, why are those numbers what they are? It brings the numbers to life to go out into the field, and it gives you more confidence. And the reason you go out into the field is 2 reasons. First, to prevent permanent capital loss, and second, to give you greater conviction in the numbers so you can make a bigger bet. But that's why we do it, and we do it all in person. We don't do it on the phone. And so it's really important to do a lot of field-based research. But the first is Unitedhealthcare. So what we did with United, and this is back in the early and mid-90s, we did the work. So the landscape in the U.S. and healthcare in the U.S. is very different than here. It's probably $3.5 trillion in the U.S. now, probably approaching $4 trillion. GDP is $20 trillion. So it's approaching 20% of GDP in America. It's a disaster. And we can't afford it. Our budget in the U.S., they're proposing a $4.7 trillion budget, but let's just say it was a little over $4 trillion in the fiscal year that ended September 30th. Over half our budget is Social Security, Medicare, and Medicaid. Social Security is $1 trillion, Medicare and Medicaid are $1.2 trillion. And you should see how they ramp up over the next 10 years, because about 65,000 people are turning, about 11,000 people a day are turning 65 in America right now, the baby boomers. So it's really frightening. But the point is, Unitedhealthcare is a managed care company, and they were trying to become a middleman between the consumer and the provider, the hospital and the doctor. And there were many competitors out there. And what we did in the field, we met with virtually, not all, but most of the big guys: Cigna, Aetna, WellPoint, Foundation Health in Sacramento. WellPoint was in LA, US Healthcare in Philadelphia. And we met with competitors and former people. And in doing that, we got some really unique insights. And what were they? Cigna, Aetna, and all the other guys were insurance companies. And what were they doing? They were applying, there's, 10 or 11,000 actuaries in America. They were applying actuarial skills to healthcare. So they were saying, what's my loss ratio, exactly as you would as if you were a P&C insurance company, reinsurance company, life insurance company. That's how they thought. And so we did all these interviews. And unfortunately, I wasn't smart enough at the time. I was a lot younger then. I was 30, 31, 32 when I was doing the work. But what came out of it was we did all these interviews, and then we finally came across Unitedhealthcare and Bill McGuire. Now, Bill grew up in Texas. He was a basketball player. They got a hold of him. He was a physician. And they got him when they made an acquisition in Colorado. But all the other companies, all of them, and this isn't visible in the numbers, all the other companies, like I said, were actuarially based. Well, when I met with Bill, what was unique and different, and if I'd have recognized that, I'd have made hundreds of times my money. Unitedhealth and Bill was a true visionary. And what he would do is, rather than look at actuarial numbers purely, he would think to himself, what are healthcare needs? Let's see what the healthcare needs of the patient populations we're serving, and let's go build businesses around them. A totally different way of thinking, which is profound. He looked at the world differently, and we didn't recognize it. We did a few years later, thank God. But the point I'm making is, if I'd have recognized that one distinction, it was enormous. Now, why is that important? It's important because we bought it a few years later, but I did that slide presentation during Obamacare in January of 13. It's 60 or 70 pages. And we had bought the stock as low as 10 or 15 or 12, many years even earlier. But in January 13, you got another opportunity. Because of Obamacare, people were terrified. But we knew United. And like I said, if you want the presentation, you can get them from Allie. I don't want to bore you with going through slides. But here's what was unique. Because of Bill McGuire and his team, he created 3 non-HMO businesses. So they were number one in virtually every area: commercial insurance, Medicare Advantage, Medicaid. They had geographic diversity. They had product diversity. These are the traditional HMO, PPO, which is a little broader network businesses. However, because of his vision, and now they're all doing it, he was doing it 25 years ago. He created what's called Optim Insight. It was really originally called Ingenix. It's a data analytics company. All they did was data analytics. They would take all the information from all the patient populations and create data. That company today is Optim Insight. It's going to do $6-7 billion in revenue, and they make 20% margins. It's extraordinary. If that were spun out, and I tease them all the time, if they spun that out, that business is worth 15, 20, 22, 23, 24 billion on its own. So that's one business they created, Optim Insight. Another one was Optim Health, which has behavioral health and a multitude of other complementary businesses in there. Another great business, again, like Optim Insight, unregulated, very profitable, nowhere near as profitable as Optim Insight, but another wonderful business separate from the HMO managed care business. The third business they created was basically prescription drugs. They now compete. There's only 3 big guys that provide medicines in the United States: Express Scripts, Caremark, and the pharmaceutical benefit manager at Unitedhealth. And so he has his own pharmaceutical benefit manager within Unitedhealth. So what was my thinking? At the time, in January of 13, people were really scared about Obamacare and universal health and what it was going to do to the existing legacy players. So what happened was, stock was $52. There are a billion shares out. You could have bought the entire company, excluding debt, for $52 billion. And we were thinking, based on the numbers, and they're all in the report, based on the numbers, you were basically buying or getting those 3 Optum businesses, Optim Health, Optim Insight, and the PBM, which was the 3rd largest in the country. You were getting them for free. I had no idea valuation. I'm not that smart. I'm not that precise. But the point is, I thought those 3 businesses someday were worth 50 to 100 on their own. And the 52 was paying me for the old legacy businesses. Well, the stock got to $286. It might be $250, $260 now. So the point I'm making is, because he thought differently and created those 3 Optum businesses, virtually unregulated, especially Optim Health and Optim Insight. Now the PBMs are all coming under all kinds of scrutiny, but he had these 3 separate businesses. And if he ever spun those out, if you look at Express Scripts, which bought the PBM out of Anthem, if you looked at the valuations, those 3 companies, and I'm not saying they will spin them out, but it's a separate way to calculate value. If they spun them out, they're worth a fortune. Those 3 businesses today could be worth 30, 40, 50, 60, 70 billion on their, combined, separate and distinct from Unitedhealth's core businesses. So the thesis was unique, diversified model, different way of looking at the world, and everything really panned out. And like I said, we have clients that even paid less because we had bought it sooner than that. But that's the Unitedhealthcare story. So even though it's a large cap and a lot of people cover it, very few people really understood those 3 Optum businesses, which were unique and different. Now everybody's doing it. Aetna, Cigna, they're all buying PBMs. They're all trying to buy HMOs. They're all converting. He was doing this 25 years ago. He's so far ahead of them, it's frightening. When the government started Obamacare, whenever they had analytical issues, they would just call Optim Insight to help them with it. They have better data, better information. It's just an extraordinary company. I still worry about it. We've sold probably 60, 70% of it because the price is high, and you still worry at the flick of a pen because government pays, of that $3.5 trillion that we spend in healthcare in the US, roughly half comes from the government. And I don't trust any politicians, and politics in America is an absolute disaster. I think they should blow up Washington and just start over. But they're not going to do that. But the point is, I just worry a lot. Government is so integrally involved in healthcare that there's a lot of risks to all these companies, and we've done very, very well with it. So that's the Unitedhealthcare story. The second one, we got really lucky. It's called Zoetis. And it started, the United States is becoming much more of a lonely place. There's more single people in the United States than ever before. So pets are taking the place of children, spouses, significant others, whatever. And I saw in our own family, we have 4 kids, and it was outside of Philadelphia. We had a golden retriever, and he got sick. And I've been traveling a couple hundred nights a year for 30 years now. And so at the end of the day, I could see the amount of love and concern you have for a pet. It really is a child and a member of the family. And our dog Max got hemolytic anemia. And my wife every 2 weeks would drive 35 minutes to get a specialist doctor to deal with the hemolytic anemia. And like when you get old like me, you have these pill boxes, so you take a certain number of pills every day. Well, he was taking 21 pills a day. And I have no idea what we paid, but it was a lot of money. And I just saw the pharmaceuticals for animals, it's really like human health. And this is exactly what evolved. So I started really digging into animal health. And a lot of them were owned by pharmaceutical companies. Merck has a huge animal health business. Eli Lilly, Elanco was just spun out. I think they just did another offering. They bought Novartis's business, very big business. A lot of them are owned by big pharmaceutical companies. So I found Zoetis within Pfizer, and I started digging in. Now the problem was, because it was embedded in Pfizer, you can't tell anything. But we did some research in the field. And what we found was they were really, really unique. They had about 18% operating margins, and most of the other competitors were in the mid to high 20s. So that was one thing we thought. Then the second thing is when they have vaccines and they have pharmaceuticals. They're both regulated by 2 different entities in the government. And so we did some work talking to them, looking at their pharmaceutical pipeline. And what we found was, of all the pharmaceuticals in the prior 10 years, almost 30% came from Zoetis. So they had an incredibly active animal pharmaceutical business, a great team led by a woman, very capable. And then in the vaccine space, they accounted for 20, 25, 30% of all the vaccines that came out. So a very productive vaccine space. So that kind of got us even more interested. Now there's a lot we didn't know because they were embedded within Pfizer. How good would they be at capital allocation when they spun out? What were their true costs because they were using all these Pfizer plants? What were their expenses going to be? They had no network capabilities, so they hired SAP. They told us it was going to cost $320 million to get all their systems on SAP. It normally takes longer, so if they tell you 320, I estimate 600, and then you just add a few years on it. So there's a lot we didn't know about what would happen as an independent company. But what we did think, really good R&D, great vaccine business, great pharmaceutical business, and we really thought, and they also had 6,000, 7,000, 8,000 salespeople in livestock versus companion animal. A companion animal is a cat and dog. Livestock is a much bigger business. It was 64% of their business. They were doing about $3.5 billion then. It was 64% of their business, while companion animal was only 34, so 34, 36. So we thought, and companion animal is significantly more profitable than livestock. But one of the competitive advantages they had in livestock, they had 6,000, 7,000 salespeople going out and dealing with all these farmers all over the country, all over the world. Very hard to replicate that. So that's one. The second is in the companion animal space, and it applies in livestock. Most of you are aware of generic drugs. In pharmaceuticals, human pharmaceuticals, I'm making the numbers up, but I'm roughly right. Generics account for 80, 85%, maybe more of unit volume. But they account for a very small percentage of revenue because they're so much cheaper than traditional ethical pharmaceuticals. Well, in this space, there's no generic players. There's no Teva, there's no Mylan, there's no Forest. And the reason is there's very few billion-dollar drugs. So you could study a drug in the animal health business, a pharmaceutical in animal health, that's doing $50 million, and it goes off patent. And then 10 years later, it's doing $200 million. There's almost no generic competition to worry about. That's number one. Number two, when you develop the drug, if you get it developed and it gets through the FDA, you basically have, in most cases, you basically have global approval. Most countries don't even have an animal FDA. So if you get approved in the US, it's approved globally. Saves you a lot of time, money, and energy. That's the second point. Third point is when you develop a pharmaceutical, an animal pharmaceutical, you can create it into many different forms. Injectable, pill, liquid, et cetera, et cetera, et cetera. Once you do that, you can extend that and create many different products from the same drug. Furthermore, there's a lot of overlap between companion animals and between livestock. So it gives you enormous leverage to take that one product or that one antibiotic, different forms, different animal species that you could go over, another big advantage. So they had all these, and then there's a few, I'm not that smart, that I really got lucky on. So it came public, maybe at 25. We didn't touch it. They only distributed, there were 500 million shares. They only distributed like 100, and Pfizer kept 400 for the next year. The following year, they got rid of their 400, and then I felt better because I didn't want to buy it while Pfizer owned 400 shares. So they spun out the rest of it. The stock got hit, and it was like 29, 28, 29, 30 back in June of 2014 when we were buying it, May and June. And so what happened was we had the conviction to buy it, but then we got really, really lucky. And you have to accept when you're lucky and not smart. So what happened was their margins are now, I told you, I thought they could get them into the mid and high 20s. Their margins are almost 40%. So I'm not that smart. They've done a great job. The second area is they did the SAP in roughly the timeline they had talked about doing it. And so they'd end up spending another $100 or $200 million to do it. So that was a second great point. The third is they're continuing to grow their companion animal space. The fourth is they had tons and tons of manufacturing facilities from Pfizer. They've really eliminated enormous costs. So costs, which I didn't talk about earlier, cutting costs was an enormous advantage, which they've really cut costs. And that's been part of why the margins have done what they've done. So some of the things we were right on and our hypotheses were right. We got a little more conviction by doing those field-based interviews. We talked to competitors, customers, former people, and that gave us the conviction to buy it. And what we've done is we made it a 4 or 5% position at inception. It's now almost $100. It's selling for a very high multiple of earnings. They made a diagnostics acquisition that competes with IDEXX, which is a great animal diagnostics company. It's a great company, but it's not, in my mind, I'm not paying 35, 36, 40 times earnings for anything. And so we've been selling. It would have appreciated. So in an account that was 4 or 5%, it would be 13, 14, 15, 16%. We've been selling once it broke 85. So for most accounts, it's probably 6 or 7% of the portfolio, not far above cost. So we've taken money off of the table. We're just not comfortable. We love the company, but we're just not comfortable. The valuation's just higher than what we think. So that's the example of Zoetis that I gave. And what I decided to do, I want to leave a lot of time for questions. A lot of people ask me about the field research process, because what you'll find is money management today is all about selling product and raising assets. It's not about doing research. Everyone just says, just buy an index fund. And a little bit about our business, just a little bit. I didn't want to go into the mutual fund business because it's all distribution driven. It's competing with the passives. You can't differentiate yourself. You don't know any of the clients. All the money comes from intermediaries. We have direct relationships with every client. I have no deals. I don't pay anybody to send me money. I have direct relationships with every client. It takes longer, but it's a better business. And I can't do anything else. I'm kind of useless. I have no hobbies. I've never golfed. I work out, but I'm pathetic. But the point is our business, I didn't want to go into the hedge fund business. Those guys, many of the men and women in that are brilliant. But again, it's a high risk, high fee strategy that I'm just not interested in. And in that case as well, you get a tiny portion of a very wealthy person's money. The moment you don't perform because you're charging 2 and 20, they leave. I can't tell you how many friends of mine are in the business, out of the business. I just didn't want any parts of that either. I think the fees are ridiculous. So we created a separate account business. Virtually every client's at Schwab. So they get separate custodial statements, checks made out to Schwab. We use Advent Access software, and we customize every portfolio for each individual client. No model portfolios. If I get a new client today, I'm not buying Unitedhealth or Zoetis. It's too expensive, and we've been selling big chunks of them. So the point is we tailor it to the client. And here's a great example of the kind of client we have. We have a client who came to us maybe 7 years ago, and he gave us, our minimum's $1 million. The ADV states $1 million. If I really know them and I think they can add to it and grow it over time, we'll start with $500,000. And the reason we do that is we buy all individual securities. And on the fixed income space, you just can't buy, if you get a $100,000 account, people that have a lot less, I just help them for free. I just tell them to buy these 3 mutual funds. And I don't even charge them. Open an account at Schwab, buy these 3 funds, and so forth. When you want to buy fixed income, it's very hard when Lower Merion Township is issuing a municipal and it's $200 million and you call up and say you want 5,000 of it. It just doesn't work. And so that's why we have the high minimum. But in any case, this is a great example. We met him 7 years ago, and I really know the outdoor billboard space. I know Carl Eller, who just passed away. A couple of our kids went to the University of Arizona, the Eller School of Management, Finance. And he was a wonderful human being. He brought the Fiesta Bowl to Phoenix, the Arizona Cardinals, the baseball team there, football team. Just an incredible human being. And he had sold his billboard business to Clear Channel, which is the biggest in the country. But and this is the kind of work we do out in the field. I wanted to understand billboards, so what did I do? I got a list from the Outdoor Advertising Association in Washington, and I talked to them about a bunch. They sent me all the stats. And I saw the biggest was Clear Channel, second was CBS, third was Lamar. They were all public. And then there were several private companies in the top 10. So we went and interviewed 2 or 3 of the private companies. We really tried to understand the industry numbers, industry dynamics, and then we start doing all the work on the private and public companies. Then we got all the public company data, and we read all that. And then I say to myself, what 1, 2, or 3 people, or 4 people in the world can give me what I consider differential insights, really unique insights into the business. And I was out in LA with a client, and I met with an ad agency, and I said, what do you guys know about billboards? Because that was an area they handled. And they said, you had to talk to George. George used to work for Carl Eller, and now he's working for J.C. Decaux, which is in Paris, France. And Europe's a different business. It's more buses and stuff as opposed to billboards here. But anyway, I found George, went and interviewed him. He said, you got to go meet Carl. He had left Carl when he sold to Clear Channel in 99 or so. So I go into Phoenix, and he was 80 years old at the time. He just died Sunday at 90. A wonderful human being. I'm very sad because I'm going out there in a week, and we were going to go see him in his nursing home. But anyway, I went and saw him. Here's someone, and just think about this. Here's someone who was selling billboards when he graduated from the University of Arizona in 1952. So think about the historic, I don't care how smart you are. None of the numbers tell you what he told me. He knew everyone in the business. He gave me a historical perspective. He said why the business is, what's good about it, what's bad. He knew everybody. His former president was the president at Clear Channel. He knew all the guys at CBS Outdoor. He knew the father of the two sons running Lamar, which is public. And how did that help us? We ended up buying Lamar. So the point I'm making is he gave me 50, 60 years of insights, incredibly valuable. And that's what field research is all about. So anyway, what happened was this client that we met came to me and he said he had heard that I knew the billboard business, which I did. So I met with him, he opened an account with us, and then he said to me, in 5, 6, 7 years, Paul, I don't know the timetable, and I could care less because I can't do anything else. I'm going to be doing this till I'm dead. So he said, in 5, 6 years, I'm going to sell my business, and I'm probably going to sell it to Lamar. So I was in Chicago in May this year, and he called me. And he said, Paul, we're talking to Lamar now about selling. So I was prepared. I told him Lamar's got a market cap of almost $7 billion, and it's got debt of almost $3 billion. So it's 6.75 market cap, 2.7 billion in debt. So that's just rounded. It's 10 billion in market enterprise value. So, and they do EBITDA of 675 million. So I said, they're selling for 12, 13, 14, 15 times EBITDA, depending if you go backward, forward. It's a stable business. They have dominant market shares in rural communities. They're not in the big cities in general, the way CBS Outdoor and Clear Channel are. So I said, what's your EBITDA? So he gave me his EBITDA number, and I applied a multiple. I said, private equity today is going to pay you 10, 11 times for that because they're going to own the whole market now. They're going to have 100% in that community. So I told him they're going to pay you 20 to 25 million. So he called me like 3 weeks later. He said they want to offer him 22.9 million. So what's the benefit to us? One, I don't want to just be a product guy. I want to really be an important part of the family and really help them achieve their financial goals. So what happens now? He had 3 accounts with us. He opens up 3 new accounts. We got virtually all the money, a couple partners, we got virtually all the money, and that was pre-tax of his sale. So we have the preponderance of his liquid net worth. It's very serious stuff. He spent 16 years working for someone else to learn the business. Then he took enormous risk, enormous stress to build his business the next 24 years. We have 40 years of his life in our hands. So then you wonder why I spend like no time selling. I spend all my time on research thinking about their money. And so my point is he opened 3 new accounts. 1 for each of his sons. That'll be 75% equity, 25% fixed income. And then 1 for him and his wife. That's a joint account. That'll be 50-50. Okay, so again, I want to do a great job managing the stocks. But you think he wakes up in the morning and says, did Paul beat the S&P today? He could care less. He needs the income. He wants safety. He wants to earn as good a return as possible, commensurate with risk. That's the kind of client we want. Now, don't misunderstand me. Don't think I don't want to beat the Russell 2000 or the S&P or the Dow. We compare, every letter we send to client, we compare to the S&P and Dow for the equity portion of their portfolio. But the point I'm making is it's a different relationship. And it gives me a lot of satisfaction in knowing that we are now responsible for taking care of him and his family. It's an enormous, enormous privilege and it's just an enormous responsibility. And we take it very, very seriously. But that's an example of the kind of business we built. And so almost no one does the field-based research anymore. What they do is a lot of them hire these consulting firms and they go out and they hire thought leaders and they pay them and then they call them on the phone. It's very different calling someone on the phone versus seeing them in person. So let's say you're a former CEO, he or she, and you retired 2 years ago. Hedge fund doesn't want to talk to him or her. It's 2 years ago. They don't have a 5, 10-year horizon like we do. They want to know this about the next quote. We could care less. I could care less. So I fly to Naples, and he's the former CEO or she's the former CEO or president, and I'll spend half a day with them. I already know all the numbers. I've read all the competitor stuff. I've been looking at the industry maybe for a long time, know the industry data, read all the annuals for 10, 15 years, and then I go down there, and I don't go down with a list of questions. I just have a few themes in mind. I let them do all the talking. I let them educate me with all their experience and all. Who's smart? Who did you respect? What areas were you better in than them? Why were your margins 20 and everyone else's 10? Who's really, really good? Who was the best competitor? Who are your best vendors? How's the industry changing? I don't care about next quarter. I care about 10 years from now. And so just like I did with Carl Eller, So that's what we try and do. And the reason people ask all the time, why don't people do it? And there might be other reasons because I'm not all knowing, but there's 4 reasons that I can think of. First, it's expensive and time consuming. Most firms could afford that. Second, most firms don't concentrate enough for it to matter. If you own 100 stocks, why are you going to do this? I don't own 100 stocks. I own 15, 12, 18. And another is most firms don't concentrate, they turn over portfolios too much. We hold things 5 or 10 years. So if you're going to own a lot of stocks and you're going to turn portfolios a lot, you would never do this. It wouldn't be worth it. And another reason, in addition to it being expensive, it is hard. It's not easy. I mean, I don't think anything of calling a former CEO at home and then commuting. And I'm going to talk about that because people ask me about this all the time. And the reason I developed the skill, again, I've been enormously blessed. When I graduated, I went to, you'll like this story, I went to a Catholic high school to play football. And my parents were Greek immigrants. My mom was this little 5'2" short Greek lady. I go to a Catholic school, you'll love this. I show up at Reading Central Catholic, there's 800 kids, 9th to 12th. I didn't know anybody because I didn't go to parochial school. So this little woman came and she actually, think about how embarrassing this was. She went to every class with me the first day. So finally at the end of the day, I said, Mom, this was really brutal. Why did you do this to me? So you know what her response was? Her response was, I wanted to make sure that the priests and the nuns weren't going to convert you to Catholicism. This is what I dealt with. But anyway, I graduated, and I got into some really good schools. Villanova, I had some opportunities at Notre Dame, Pitt, and others. And we just didn't have the resources. My parents were immigrants. I had 3 older sisters, a younger brother. So I thought about going locally to Albright College, which is a terrific liberal arts school, small. I could commute and live at home, save the money. And then I was really good in math and science, so I thought a medical career might be interesting. And so Albright had a great pre-med program. So I went there, and then Dr. Chen Si ran the lab at St. Joe's, and I drove up to his house one day, never met him, drove to his house and said, if a job ever comes up at the hospital, I'd love the opportunity. So my freshman year, first semester, I got a job at the hospital. And then I went to an autopsy and I fainted. So I thought the medical career didn't really look too promising. But I stayed working at the hospital. I worked at the hospital every weekend and every holiday, and then during the week for the next 8 years. And I paid my way through school. So I graduated when I was 26. And then I was thinking, how do I get into money management? Parents don't have any money. I don't really know anyone. And so I was running around the track and I ran across an old buddy who I left after public school in 8th grade. And he was at a consulting firm heading towards Philly on the outside of Reading. He said, you ought to come down here. So I did. And I worked there with marvelous people. They all had technical undergraduate degrees from the best schools, Caltech, MIT, Carnegie Mellon, and MBAs from the best schools. And I had nothing. But they hired me. They knew my background. I knew a few of them. And what we did there was competitive analysis for Fortune 1000 companies. And it was just an incredible experience. And I really worked hard. They were all smarter than me, but I worked harder. And I developed a unique skill set to be pretty fearless and to just call people to get the information and go see them. So I did that for 2.5 years. And then July of '88, I just said, I have a skill set and I don't want to do this. I didn't like consulting for 3 reasons. I hated selling information. I hated it. Never did anything unethical, but I hated it. The second thing was, a lot of what you do in consulting is for political purposes. I'm totally apolitical. You know, the vice president at Procter & Gamble hires the consultant so he can say to his bosses, the consultant said, well, I'm not leaving my family for anybody for that nonsense. So that was reason 2. And I might add, I love consulting, but I don't want to do it the rest of my life. The third reason was, if you really have a great idea, you gotta have capital. I don't care if you charge $5 a day in consulting or 10 grand. It's just not as much fun. Plus, you actually get to see things get implemented and participate in that. In consulting, you give ideas, you give advice, you don't do anything. And so there was a little company, we were doing a huge project for DuPont. I'll never forget this. And I was 26, 27 at the time. DuPont had a little subsidiary that will remain nameless, and we got to see all the internal data. It was doing 80 million in revenue, and it was making 40 million after tax. I said, I should own this thing. And that's when I started realizing that's really fun. As opposed to consulting, this would really, and plus I'd read about Buffett when I was 13. So after I fainted, I thought I better go back to the Buffett investment world. So in any case, I picked up the phone and I called Buffett. I spoke to Gladys Kaiser. Now it's Debbie Basanik. I called many of the great money managers, cold called them. Mario Gabelli, Chieftain John Shapiro and Glenn Greenberg, Chuck Royce, Bill Ruane, called maybe 12 of them. 2 of them gave me interviews. And Michael Price, he had just moved to Short Hills from New York, and he said, Paul, if you'd called me 6 months ago, I'd have hired you, but I just hired 5 analysts. But then Chuck Royce hired me. So I went to work for Chuck. It was 2 great years with Chuck. And the reason I left was Chuck owned too many stocks because he was small cap. He owned hundreds and hundreds of stocks. I didn't want to own hundreds and hundreds of stocks. So I called a guy in LA, George Michaelis, who was running First Pacific, and then it became Bob Rodriguez, now it's Steve Romick. They probably have 30 billion. And he said, you know, Paul, you ought to call Bob Goldfarb at Ruane Cunniff. So I did, and then I got lucky again. He sent me the Sequoia Fund letter, and they owned Russberry and Kimball, and I did huge projects for Chuck on them, and I really knew him. And so I ended up getting a job for Ruane, and Bill was one of Warren's best friends. So during my time there, it wasn't directly for Mr. Buffett, but through Bill, I did 4 or 5 projects for Warren, for Mr. Buffett, and I got to send him the work. So it was an extraordinary place. I loved every minute of it. They allowed me to stay in Pennsylvania because I was traveling over 200 nights a year doing due diligence for them. And it was a perfect home for me. Why? They had quasi-permanent capital. Sequoia Fund was started in July 15th of 70. Buffett clients had given him $25 million back then to start it, 25 million. And they had direct relationships with the clients, not like today. Plus, they had a separate account business. They had great clients. They had quasi-permanent capital. And they concentrated enormously. I'm not as smart as Bill or Mr. Buffett, so I won't do 5, 6, 7 stocks, but that's what Bill did. And I had the privilege with Carly and Greg. We each applied our own unique set of skills to studying those businesses, and I got to do primary research on all of them, which was phenomenal. It was a phenomenal education. I got to fly around the world and just learn. But again, almost no one does that today because they don't have the capital Ruane did. They don't concentrate like Ruane did. And they don't hold stocks as long as Ruane did. So it was a really, again, very blessed and very lucky. I did it for almost a decade. I was a partner for 6, 7 years. And then I just made up my mind as I was running around, I wanted to generate my own ideas and do my own thing. So again, given how intelligent I am, a wife who hasn't worked outside the home since '89, this is 2000, we're in the bubble. I was the only income. I quit, had no clients, had no track record, and I started our business. And I have no regrets. I've loved every minute of it. It's been really, really daunting. And the business model I've chosen is a very tough one. But I have a 40-year horizon. I just have to live. So hopefully I'll live. But in any case, that's my background. So what we decided to do then in building our business, no mutual funds, no hedge funds, direct relationships. We have all separate accounts that we customize for each client. And we can do whatever we want. We have no market cap constraints. We have no geography constraints, although I don't invest in India, China, Eastern Europe, if I can't add value. So we invest primarily in the US. We'll look at Mexico, Canada, Japan, Korea, and Western Europe. I've been to Western Europe a lot, so I know the companies there. If I can't add incremental value, I won't invest there. And then finally, I just wanted to talk real briefly about Differential Insights, which is really what we're looking for. The whole focus of this is never losing money. Buffett's rule number 1, never lose money, permanent capital loss. We don't mean if stocks go down a little. We just mean permanent capital loss. And the second rule is never forget rule 1. And so we try to base it on a sound analytical framework, and we look at the business model, management, and valuation. We're always thinking about those 3, the business model, management, and valuation, and they're all interrelated. They're all, it's like 3 circles, and then in the center, they all intersect. We always want a margin of safety, and the value of the business is the intrinsic value. We never think about the market. In the short run, the market's a voting machine. In the long run, it's a weighing machine, according to Ben Graham. And then we dream. We think about what's knowable and important. We develop a hypothesis. Then we do secondary research, literature searches, and then we do the primary research. We find a network with thought leaders. We prepare for the interviews. I do phone interviews, but only to set up the personal interview. And I do a lot of role playing. I did a lot of role playing to get good at that. And then ultimately, we create a research map, and then we go out into the marketplace and start putting all of it together. We already know the numbers, the industry data, the company numbers. Then we start putting a research map together of who we want to talk to and what questions we have and what's knowable and what's important, and go from there. And then after we're done all that, we then make our decision. Are we happy with it? Are we comfortable with it? Are we not? So that's pretty much it. I want to open it up for questions. Ask anything you want.
Thank you so much for coming here today and talking to us
My pleasure.
about your experiences. My first question is about your field research. You mentioned a lot about how you talk to the management, but the other aspect is also you mentioned that you talk to the suppliers and the customers. How do you go about meeting these people, and how do they give you time to talk to them? Like, they will be busy with their own work. Like, how do you get them to talk about inside perspectives about the company you want to invest in and give an independent opinion?
It's really funny. I'm asked this all the time. And just so you understand, when I was in consulting, it was really, really hard because we did proprietary research. So a client would hire us, and let's say I called you and I said, I'm evaluating, I'd love to talk to you about so-and-so. You were written up in this article and you know this industry, you're considered a thought leader. I'd love to come talk to you. Smart people, it didn't happen often, but smart people would say, who are you doing the study for? In consulting, I couldn't tell them. It's a proprietary project, I can't discuss it. Now it's easy. I'm Paul Lountzis, I'm with Lountzis Management. We manage a few $100 million. I'm doing an analysis of the insurance industry. Your name keeps coming up. I'd love the opportunity to come down and meet you. I'll send you literature on our firm. I don't publish anything. All the data is kept internal for the benefit of our clients. I don't sell anything to anybody. It's all used captively. But the point is, so point one I would make, going from consulting to money management, it's a lot easier because I can be totally upfront. There's no BS, there's no lying, I tell them exactly what I'm doing, And I also offer them at the end of the project, if they want to call me in a few months, I'll tell them what decision we made. Because they're kind enough to share their time, energy, and resources with me, I'll do it with them. And I never pay anybody. I paid 2 consultants in 30 years because they had legitimate consulting firms. And it's not because I'm cheap. I just think it compromises people. And it's just silly. And so one of the things I do is, and you'll find this, and it was more of an issue when I was smaller, but what you'll find is if you really do your homework and you're really knowledgeable and thoughtful and honest and upfront, you would be amazed at how responsive people are. They love to talk about what they did. If they get to trust you on the phone and you send them the literature and you do everything you're saying and they meet with you, they just open up and they just share what they've done. And you got to understand now, I'm not talking about proprietary data or a drug formula that, I don't care about any of that stuff. I don't care about unethical, illegal stuff. I just want to get someone who's been in the business, like Carl Eller. He had sold his firm many years, he had sold his firm 7 years before I met with him. But he started selling billboards in 52. He gave me enormous insights into the business. I don't care about next quarter's earnings or what new drug, did I talk to somebody at the FDA illegally that told me a drug's going to get approval? I don't care about any of that stuff. I'm never going to do that stuff. But the point is, you'll find if you're open and upfront and tell people what you're doing, you'd be amazed how open they are. And look, I've been doing this so long. I mean, I don't know if any of you have ever cold called people, but one of my favorites is, and Tina screens all my calls. I don't have time to talk to all these people, but the point is, I love when people call you, and this is just a little simple thing. People call you and say, is this a good time? No, bye. No, what I'm saying is there are certain, you never ask someone that. It's their time. That's just, so, and the way you get good at it, like let me give you an example. I sit down with you and I say, okay, I'm the former CEO of Company A, and I retired a year ago. I'm now living in La Jolla, enjoying the warm weather in San Diego. You call me and try to get to come interview me, and we role play. It's brutal, but that's what you got to do. So you call up, what do you say, and then I respond, and then you respond. You only get good at things by doing it. You can read it in a book all you want. You got to do it. So my point is, people do open up and share with you if you're open and honest.
Thank you so much. I have a follow-up question to that. So, I mean, I actually am going into consulting after the MBA.
Uh-oh.
So it was interesting.
Don't talk about me. I told you, I loved it, but I didn't want to do it forever.
So my question is like, I'll be stretched with work in consulting, and I also want to pursue value investing on a personal side. So how important would be, from your perspective, how important would be field research then? Because you won't be able to invest that much amount of time um, as a personal investor.
What I would do in consulting, and I wasn't smart enough to, as I look back, certainly didn't know it. What I would do in consulting, it's a great field with many incredible minds and incredible opportunities to learn. So what I would do in your shoes, I would learn as much as I could about as many industries. I probably worked on 20 industries when I consulted for almost 3 years. And I built, in fact, 5 of the people I worked with are clients now. And then build as many relationships as you can. That's what I would do. Keep improving. It's a wonderful place to hone your analytical skills, simplify your thinking, learn to communicate verbally and in the written word. Consulting is a great training ground. I mean, the 3 best places to really learn to be an analyst are consulting, being a CPA in a small auditing firm, auditing businesses, and the third is being on the buy side or sell side research. Those are the 3 best. Consulting's one of them. And I loved it. I just didn't want to do it the rest of my life because I wanted to go into value investing. But that's what I would say to you. It's a wonderful place for you. Build relationships, develop your analytical skills, develop your verbal and written communication skills. It's a great training ground to get into value investing. And then you can do a lot on your own if you have any time and you're not traveling a million days a week.
Yes, thank you so much.
You're welcome.
Good evening, Paul. My name is Rohit. Thank you very much for coming here. We are about to start our career, and your advice you gave to students, I think that was very, very helpful. My question is a little bit on the relationship building. What I feel difficult is to whom to select. I want to remain connected with that person, and to whom not to follow up. So what is your criteria when you meet the person first time that you want to be connected with this person over a longer period of time and you really want to build a relationship? If you can a little bit throw a light on that, that would be great.
Yeah, that's a great question. You're going to meet so many people during the course of your career. So what I try and do is, as best I can, I keep a list of people that I really like, really respect, and enjoy being with. And then I just, what I do is I'll send them a handwritten note or I'll send them an email to just keep the relationship going. So they know, I'm thinking about them or whatever, but it can be difficult.
Just a follow-up on that billboard story. So when you met with that guy, you said that he opened a free account with you. So can you elaborate, that happened in your first meeting or it happened over a course of few meetings?
When you mean the billboard guy?
Yeah.
Yeah, the billboard guy became a client probably 6-7 years ago. So we were in business 12 years. So that wasn't the issue. But 4, 5, 6 years later is when he called me. He had told me at that initial meeting that he was probably going to sell someday. But then he didn't call till 5, 6, 7 years later when they were actually talking to Lamar. So it's a long-term game. It's not a short-term game.
Thank you.
You're welcome.
Thank you so much for coming. I just wanted to ask a little bit about, you spoke to like the holy trinity of things you look for in a business, specifically with owner-operators and management of the business. What kind of trends have you observed amongst successful management? Do you kind of look for like the foresight you spoke to in Unitedhealth, or kind of deep industry experience, like a passion for the product?
That's a great question. I think on the owner-operator or leaders of a firm, when we look at a management of a company, we focus on 3 things. And a lot of it you can tell from the numbers. The first is, how good are they as operators? So if you're looking at company A, what are the returns on their business? How good are they at operating the business? If you look horizontally at all their competitors, are their numbers better and why? So that's one. So are they good operators in the business? The second question is capital allocation. And you'll find there's very few leaders, male or female, that are really great at both. And I hate to pick on her because there's not enough women in business leadership roles. It's pathetic. I mean, 20 CEO women are 30 out of 500 in the essay. It's pathetic. But the point is, Jill Barat is an example of the capital allocation. Here's someone who was a brilliant operator. She built the Barbie brand at $2 billion with her team. You don't do anything by yourself. But she built the Barbie brand at $2 billion, and then they made her CEO. Her and the team there ended up buying the Learning Company because children were migrating out of traditional toys more rapidly. And they wanted, these little, you wouldn't remember, but these books you open and they would speak to you and so forth. So they paid $800 million. The learning company was $800 million in revenue, and she paid $3.6 billion. She paid 4 times revenues, 4.5, whatever, okay? When Bob Eckert, who used to run, he worked at Philip Morris in Chicago, he ran Kraft. When he came out to take over for Jill Brad, he sold the business to the Gore brothers for $1. $3.6 billion got wiped out. So she was a brilliant operator, and I don't want to just pin it on her, it's the whole organization. But it was basically, she was a great operator, but then they made her CEO and you have to allocate capital, and didn't do a very good job of that. So the point I'm making, so operator, how good are they as an operator? How good are they at a capital allocation? That's harder to tell, but you can still learn a lot from the numbers. And then the third factor is, are they shareholder oriented? Did they take the rewards and share them with the shareholders, or did they pocket them? And you can tell a lot of that by the proxy. I read every proxy. I've read hundreds. And when I see how people get compensated, it really impacts how I look at it. And then the final point I would make is, and I'm biased here, it doesn't mean I'm right, we love owner operators. Phil Knight, Howard Schultz, Bezos, I wasn't smart enough to buy Amazon. But Phil Knight, Howard Schultz, Bezos, Bill Gates, people that start a business, they just look at it differently. So what's your first name? So Noah, you're hired to run company A. And I'm not trying to diminish you. You don't have those visceral feelings of starving to death, sleeping at the office, and trying to build your vision. Even though you're a CEO and they're making ridiculous amounts of money, you're a hired hand. And not that you're bad, and not that you're not going to do a great job. It's just not the same. You don't look at it the same. So our preference, like Progressive's a great example. Do you guys see the commercials up here? Progressive Insurance. It was founded in '37 by Peter Lewis, his father, who was an attorney, and his law school buddy from Case Western Reserve in 1937. In 1960 or so, Peter joined out of Princeton. In 1977, 40 years later, they hired their first 3 MBAs. Mike Krause, Chuck Choquel, and Jim Pouliot. I know that because I interviewed 2 of them when we were doing the work at Ruane. And the point is, they were doing almost $50 million in premium in '77. So 40 years after they founded the firm, they didn't make acquisitions, which I love, but it takes forever. 40 years after they founded the firm, they were doing $48 million in premium. He said to those 3 MBAs, by 1990, in 13 years, we want to be $1 billion. They beat it by 2 years. This year, they'll do $30 billion. And they're number 3. They just beat Allstate. It's State Farm, and then Geico, and then Progressive. They're going to do $30 billion. But do the math. It took them 80 years to get there. People who aren't founder owners don't want to do that. They want to make acquisitions. They want to get bigger. Then they get to make more money. They hire these consultant clowns who come in and say, well, this company your size makes this amount of money and blah, blah, blah. A founder owner owns stock. Bill Gates never thought that way. Peter Lewis owned billions in Progressive stock. It's a different mindset. So I hope I answered that.
Yeah, thank you very much.
And don't get me in trouble with consultants here.
Yeah, I just wanted to ask, because you mentioned mistakes. Sometimes investors can make mistakes because of just innate human behavioral biases. So I wanted to know some of your techniques that you use to avoid some of these, such as herding, and there's just many others.
That's a really good question. First, I want to tell you a couple of the mistakes I've made. I just told you about Mattel. Mattel stock dropped from, when some of these problems, the learning company came out, it dropped from 45 to 22. And we thought at 22, they were doing $4.5 billion in revenue. They had almost $2 billion in Barbie. They had Hot Wheels and Matchbox. They had all kinds of really good brands. And so we bought it at 22. And while we didn't lose money, it went down to 9 a couple years later. And we ended up selling it a little bit above our cost. But if you look at the time value of money, we really cost our clients money. So we might have sold it at 25 or 27, but that was one mistake. Most of our mistakes And there have been so many, and we'd be here all night. But most of my mistakes have been mistakes of omission, not commission. And again, like I said earlier, by omission, I don't mean a stock that went from 10 to 300 that I never looked at or don't understand. I mean you did the work, you did the analysis, and for whatever reason, you didn't have the courage or conviction to pull the trigger. And here's a great example. This is really, well, the first one I already talked about was Unitedhealth. If I were smart, in 1993, we did all this work. We flew around the country, Andy Nieder, my colleague, and I, brilliant guy. We did all this work on HMOs. And if I'd have recognized, and I should have, it's in the interviews. I read it now and I get distraught. We said in the interview they were different. They thought differently. They were building non-managed care businesses, these Optim business, which are now Optim businesses. If we'd have bought that, we'd have made an enormous amount of money. We didn't. Another one, which is I talked about in the question session, was a company called O'Reilly. I don't know who's up here who does auto parts up here? Is O'Reilly up here? I don't think so. You know, like you go into an auto parts store to buy stuff, the oil filter. I mean, I'm not familiar with it. I can't fix anything. I wouldn't dream of doing it. My wife won't let me touch anything, even the grill outside. But the point I'm making is I met the people at O'Reilly in the mid-2000s at the Gabelli Automotive Conference. And I talked to Mary about it, a brilliant investor. And I really liked the people, Midwestern, humble, thoughtful, shareholder-oriented. And they had two businesses. They have the do-it-for-me where they sell to mechanics at dealers or independent shops. And then they have the auto stores where you go in and buy stuff to fix your car. And they bought CSK in 08, 09, and that really increased. They used to be close to 50-50, do it for me, do it yourself. CSK really skewed them more to the store business. Well, the stock was $30, $35. I hated the store business because I just think down the road, it's more clear now, but I still don't know the timing. I don't think anybody's going to go into a store to buy stuff to fix their car. It's all computers now. You don't know how to fix anything. So I watched it go, and this again shows how smart I watched it go from 35 to 350. Never owned it. Then I got another opportunity, and again, I'm a dummy. The summer of 17, a year and a half ago, I put it on our buy list. It went from 350 to 169. I won't bore you with why. I watched it at 169. At 171, my trader said, "Do you want to buy it?" And I said, no. And the reason was they brought down the amount of stores, so now it's getting closer to 50-50, but I still don't think the store business is a good business. I think that business, I could be wrong, guys, but I think in 5 or 10 years, no one's going to go to a store to buy anything for their car. You're just going to have it all serviced. That's assuming we're still even driving cars. It's not as a service like Uber. I live in New York now. We never drive a car. But the point is, I passed on it at 171, and I'm so intelligent, it's now 400. And that's happened repeatedly over the years. But again, you just can't foresee the future. I may be right. I may not be right for 6 years. So I don't know if that answers your question.
Yeah, I mean, I wanted to know more of these techniques that they use on a daily basis.
One of the things we do, which I talked about earlier, is we basically play devil's advocate. So when I generate an idea or anybody generates an idea at the firm, we try to beat it up. And we don't attack each other. We attack the idea. And that's a really valuable way of trying to avoid anchoring and so forth. But that's a very, very good question.
Thank you.
We have a checklist too. We have checklists as well.
I wanted to ask a question regarding the client management aspect of asset management. So when you're speaking about the story in which the Billboard CEO, you were aware that you're managing a lot of his wealth, how do you sort of deal with when the portfolio doesn't do so well or when there's a downturn? How do you manage those relationships?
That's a very good question. What we try and do is we stay in touch with them. We're really open. They get a monthly statement from Schwab, which they can see every month, totally independent of us. We download every morning every client account from Schwab into our software, and we reconcile every account every day. And then quarterly, we send 4 or 5 documents to them, clearer and better than a brokerage statement. And then twice a year, I send a letter. Now, in the middle of the year, in July, I send out a 2, 3, 4-page report on what we've done the first 6 months. That's pretty much it. But year end, I send out a 30, 40, 50, 60-page letter. I tell them everything I'm doing. And don't forget, we're not huge by any means, but a good example of that, and knock on wood, hopefully it'll continue. In 08, 09, when the market was getting killed, we got one phone call. We really try to communicate up front. So for example, when we meet with a client initially, I don't even talk about investing. I want to get to know them. And tell me about what you do. Tell me about your family. Ultimately, we often get their personal financial statement and all their wealth. If they own real estate, I often think that's great, whereas a lot of people say you should liquidate that and give me the money. I treat them as if the role was reversed. So if I was in their shoes, what would I want as someone managing my money? So up front, we're brutally honest, and we turn away a lot of people. I don't care how much money they have. I just don't, because it won't be happy for them and it won't be happy for us. So we say to them things like, have you invested in 401ks and IRAs every year? Has your spouse? Do you have plenty of liquidity? About 70% of our clients are small business owners, so we're their safe capital. They have enough risk. So we say to them, do you have enough liquidity in your business? Keep more than you need. Do you have enough liquidity personally? If your family wants to buy a home, a summer home in Avalon, go buy it. Don't give me the money. Keep plenty of liquidity personally. We go through this whole thing of what they should do. After they've done all that, then we say to them, then maybe we're appropriate for you to think about investing with us. Because we don't want them to come to us to take money at an inopportune time to do all those other things that they should be doing that are more important. 401k, growing tax deferred, all that stuff. IRAs, liquidity in your business, liquidity in your personal life. And then we say to them, the pool of capital that you're looking to give to us, what is the primary purpose? Growth, income, a combination thereof. We really try to get to know, and then we'll decide with them, based on their needs, an allocation. 50-50, 40% equity, 60% fixed income, etc. And then once we formulate an allocation, then we say to them, the portion that's in stocks, let's say it's 60-40, 60% stock, it may take us, and you may not like this, it may take us a year or longer to fill that portfolio with stocks, 60%. If you don't like that, don't give us the money. Now contrast that if I'm running a hedge fund or a mutual fund. Try getting away with that. I mean, we haven't bought a new stock in a year. We've bought existing holdings for a new client, but we haven't bought a new stock. I can't find stuff that's compelling because I'm looking for the stuff I'm talking to you about. It's hard. And so at the end of the day, we really try to get to know them, understand their needs, goals, and objectives, and just be brutal. And what you find is by being open and honest and upfront with people, they respect that. And we've had clients, and you got to remember, our biggest family account is combined, and they have several accounts. It's probably 25 or 30 million. If we ever were blessed enough, which I'd love, if we ever got a 100, 200, 300, $400 million family, which I'd love, we'd never want to run it all. We could run 30% of it, 40% of it in separate accounts, trust for the kids, grandkids. We would allocate. But if we allocated, we would charge 1/5 of what we charge. If I sent money to people I really respected in the public space that do things I don't do, I would charge 20, 25 bips. That's it. And then long term, as we build the organization, we would do private equity as well, going in as co-investors. I would never take, a wealthy family with 400 million might say, I want 40 million in private equity over time. I would rarely take that money of that family, unless they wanted me to, and put it in one of these private equity funds, lock it up for 15 years and pay somebody 2 and 20. That ain't happening. But if I could, I'd go in as a co-investor where you pay almost no fee and almost no carry. That's what. So with a big family, it would be different. So it depends on the individual client. But the point is, it's very labor intensive, but I want this relationship to go on in perpetuity. And so that's another thing we do. We take all the kids. So if let's say we have that $25 million family, if a kid has a $40,000 401k or rolling over, it's way below our minimum, we'll take it. But that's a great question.
I just had a quick question on your research process. So it seems like you employ a top-down approach where you find an industry you're interested in and then do field research and then identify a company that you'd like to invest in. I was just wondering where the inspiration comes for at the beginning to identify the industry you're interested in and then make the decision to commit significant resources to do the field research.
I would clarify that we're really not top-down, but it's a combination. A lot of times I find companies that here's what stimulates me. When I see companies in an industry that I think are different, when you see a company that's different or an executive that's different. So a lot of times it's not top down. Like I don't say to myself, I'm going to look at cable and which is the best company. I don't do that. Normally it comes from the bottom up. I see this, I'm making this up. I see a Progressive commercial and I think, boy, they're different. Or I see, you know, my wife will come home and say, you know, I go to Ulta all the time. That's another example. She used to say to me, honey, Ulta, this is an incredible store. I would have made like 15 times our money, but I didn't listen to her. So a lot of it is really bottom up. But where you're right is we do top-down work because once we identify a company or even an industry, we love to know all the industry data. So if I'm looking at pharmaceuticals, how big is the industry? Who are the major players? If I'm looking at the railroad industry, you know, there's 7 of them or 6 of them. You know, how big? So I like the industry data, but we don't say we're looking at railroads, let's go look at that and then go down, top down. But we do want to know all that info. So a lot of my ideas come from the bottom up, the individual company, and then we go from there.
Hi, Paul. Thanks for coming today. My name is Zoltan, one of the MBA students here. So I have a broader question around new, I guess, investing movement happening broader within the space. Not sure if you're directly involved with it, but I'd just love to get your takes on this because there seems to be a larger and larger focus on it, both here at Ivey and both across the industry. So in 2018, 26% of total U.S. assets were under professional management using ESG strategies. So $12 trillion, tremendous amount of money, and it's growing. It's great to see. And Larry Fink had this great quote from his annual letter to his CEOs of society is increasingly turning to private sector and asking that companies respond to broader societal challenges. Without a sense of broader purpose, no company, either public or private, can achieve its full potential. And I was recently at a conference in Toronto where former CEO of BP, Lord John Brown, and McKinsey co-authored this study where they looked at this platform called Connected Leadership, where they looked at companies that radically engaged with society and defined their contribution according to the major challenges that we face, not just as a society, but as a world in broader context, and really showed that they have a long-term competitive advantage that is on par with intellectual property. And their premise was that in an increasingly crowded field, that to look for these kind of companies will lead to outsized returns in the long run. So a bit of a rounded question, but what is your view on this? I'd love to hear your thoughts.
You mean the environmental, social, and governance stuff that's really taken off?
Yeah, and the connection between that and that actually leads to a long-term competitive advantage for companies.
You know, I read about it all the time, and I know a lot of money's flowed to that area. But what I would say is, I think it's wonderful as a company to have as broad a perspective as you can to the community and the world around you at large. But here's the challenge in that, and I don't know enough, so I can't comment. That's another thing that's important in investing. You have to learn to say, I don't know. And people don't like saying, there's so much I don't know, it's unbelievable. But the point is, I would question the profitability issue. And let me give you an example. Let's say you're a manufacturer in the Midwest of the United States, all right? And you're non-union, so we'll remove that. But you have certain costs you have to incur. Now, gas costs and fuel costs are going to be a lot lower than they are in much of the world because natural gas is like going nuts with the Marcellus. We just went over 100 billion BCF in this country. But the point is, there's some advantages. But someone in China who's doing the same thing, now their labor costs have come way up because population, they've left and gone to Vietnam and Malaysia and other places now. But the point is, there's no environmental regs. There's no government regs. Their cost to produce, even if labor rates were the same, which they're not, and other things, how are you going to be more profitable here than they are? That's point one. The second point I would make is, while I agree conceptually that as a company you have an enormous responsibility that's more than just making profit, you have a broader societal role, climate change, and all these other things that are occurring. I agree with all that. But the question becomes, you're in a very tough spot because your job is to really be as profitable within reason as you can. Those are secondary considerations in my mind. And so, I love the idea of solar and voltaic and all the rest, but at the end of the day, it's really tough as a CEO when you're competing with all. Give you an example. Look at the tax code in the US. And everyone says, it's so easy to say these corporations and what they're, so you're the CEO, he or she. So she's the CEO of Honeywell. And you have all these divisions. And you're paying a 35% tax rate. And let's just assume you're paying it all, okay? And a major competitor moves to Ireland and is paying 12. What do? You go offshore. And then you got people yelling at you. Well, the reality is if you don't, thousands of jobs in the United States are going to be lost. You can't compete. So the point I'm making is it's complicated. Conceptually, I agree 100%. I wish everyone would be great on the ESG side and have a perspective that's broader than just making money. I agree with all that. But I think it's hard. But you can do it. But they should all keep moving. If everyone was forced to do it, it would be great. So that's my response.
Appreciate it. Thanks, Paul.
Yep.
Hi. I just wanted to ask about how some people who enter the investment management space might choose to specialize in a specific sector. For example, you become like a tech analyst or like a healthcare portfolio manager. Some people say like through this process you can develop like deep industry skills, and that may or may not be like a competitive advantage versus people who might be agnostic. And I just wanted to hear like what your thoughts are on the pros and cons of like specializing in a specific subsector or sector, and how that compares to agnostic, and maybe why you chose to like be more industry agnostic, like what your thought process.
That's a great question. I have many friends, especially on the sell side, but also, the traditional track, you guys are all familiar with the sell side. You publish research for Merrill or Goldman and you cover one industry, technology, internet, railroads, whatever. The pros of that are what you said. The pros are you really get to dig deep in an industry and learn that industry really well. You know all the major competitors, all the customers. I just can only speak for me. Because of the way I started out, all the firms, when I started with Chuck and with Ruane, because I did competitive analysis, I was trained to be a generalist, okay? But just think about this. So let's say I hire, and the way it works is you're on the sell side and you're a software analyst. And the way you build relationship is the buy side calls you and you talk to them. And ultimately they hire you on the buy side, but they hire you to do the software for them rather than being on the sell side. So you're still doing software. I can just speak for me. Let's say I hire a railroad analyst, all right? There's 4 big ones in the United States, a couple up here in Canada. So your job every day, he or she, is to study railroads, right? That's great for about 6 months. Let's say the valuation of railroads is up here, and there's no way the portfolio manager or your clients are ever going to buy them because they're too expensive. What do you do every day? He comes in, she comes in every day, and they're looking at railroads. And the valuation is here. And you just keep looking at it, praying the valuation gets killed. It could take 3 years. The point, and I'm not trying to diminish that. All I'm saying is a couple things. One, for me, I would love to do that. After 6 months, I'd be bored out of my mind. I got to learn something else. The second thing is, think how much more valuable you are if you know 4, 5, 6, 10 industries intimately. You're so much more valuable to a buy-side firm than one person. I'd never, for me, I can't speak, I'd never hire someone focused in one specific industry. I want a generalist. And the other thing that's beneficial is, by being a generalist, a lot of industry data flows from one industry to another. So it works. You're more valuable, it's more fun, and it's just better for everyone in my mind. So that's what I would say.
Just a quick second question is, you mentioned you take a bottom-up approach and not a top-down one, but are there like any industries that you recently came across that you think are like tremendously are going to do really well over the upcoming years, and like maybe like an example of one, or like why you think that?
What I would say to you is, I really want to stress this point. A lot of value people always talk about being bottoms up. Bottoms up alone and exclusively is nonsense. I hate retailing. I bought 2 retailers in 30 years. But we bought Lowe's many years ago in the high teens, low 20s. It's an oligopoly with Home Depot. Home Depot is 50% larger. Home Depot's margins are 500 basis points. I won't bore you with all the details, but the point is we've sold most of it, probably over 90% of Lowe's. But the point I'm making is when people say they're bottoms up, how can you own Lowe's and not know what interest rates are, which is macro? How can you not know what housing starts are? New home starts, multifamily. So there's a million macroeconomic factors that we value. So I don't think saying you're bottoms up alone or top down, it's all related. And so there's a lot of industries where we always want to know the industry data, but we never ever make decisions. Like we would never say, okay, interest rates, the 10 years, 270, 260, we think in 3 years it's going to be 5%, so housing is going to get killed. And by the way, we don't sell short. But let's say you had that thesis, you'd sell all the home builders short, or you'd sell Lowe's short, or whatever. The point I'm making is we look top down, we look bottoms up, but we never ever make decisions from top down data. But top down is enormously important. And one thing you learned in 08, 09, if you're just bottoms up, that's a huge mistake. You've got to know the industry and the macro. Every business we own, macro factors affect them. That's a good question.
Hi. So you operate separate account for each of your client. And one of the things that I really am interested in hearing about, but we don't get to hear very often, is the portfolio management side of asset management. Could you tell us a little bit about how you weigh your portfolio for each individual client, especially the equity side of it?
Yeah, the way it works for us is every client's really different. I mean, you could get a 75, and I'll tell you what's really challenging. And this really applies especially to women because women live a lot longer. And let me give you an example of one of the challenges. We had a woman come in with just under $500,000 several years ago. And she had been at a brokerage firm that will remain nameless. And they lost $1.5 million during the crisis. Well, look, I work really hard. I can't replicate $1.5 million in 2 weeks. And so she came with, just to make it simple, for $500,000. And she was really sincere and a wonderful lady. And she needed $65,000 a year in income to live. Now, if you do the math, 12, 13, 14% on $500,000, it's not possible. And think about it, you could never put 100% of that portfolio in the stock market. So we never took the account. And I felt really terrible because you know what she's going to do? She's going to go to some schmuck and he's going to tell her he can get her 15% a year. And you know what's going to happen to the $500,000? It's going to vanish. But the point I'm making is, and think about this, the point I'm making is she could easily live another 30 years. So another way to look at it, and I'm prefacing this, let's say someone comes to you with $1 million, which is our minimum. Now to all of us, $1 million is a lot of money, all right? The way to look at it is, forget a money manager, look at that $1 million and say to yourself, how much can I earn at the risk-free rate on that? So forget the 5-year or the 1-year US Treasury, forget the 30-year. Just take a 10-year Treasury. So you took that $1 million and you want to take no risk. You buy a 10-year Treasury. You're going to make 2.7% on that. You're going to get $27,000 on that $1 million. And you got to pay tax on that. So think about it. So the point I'm making is, what's scary is 40% of people in America have no retirement to speak of. So that $1 million, while in absolute dollars it seems like a lot of money, you have to look at it like what can it generate risk-free, and then go above that based on your risk tolerance. So the risk tolerance of the client is really important. How much money they have. And it's sad, but it's true. The more money you have, the more money you can make. So let's say a client comes to us with $10 million, and they say, I need X amount to live on, and rates are really low. But let's say I could take $5 million of that and get the hurdle rate that they want. We could take the other 5 and invest it in the equity markets. And that could grow over time, long periods of time, at a much higher rate and go to their children, grandchildren, whatever. You come with $1 million, it's very hard to do that. It's very hard to even make enough for them to live on. And the other thing is, once they start dipping into that principal, money vanishes like that. So the point I'm making is, we really try to know the specifics. We try to be careful on the equity side. We let them know, look, those are going to fluctuate. But if they need income, we make sure that we have enough on the fixed income side to really satisfy. We have a lot of our clients that have money wired right into their account for free from Schwab every month. And we got really lucky. About 7 years ago in 2012, we found fixed adjustable preferreds. I never bought a preferred stock in my life, ever. And the reason is most companies that issue preferreds have bad balance sheets. They don't want to issue common stock because it's dilutive, and they don't want to take on more bank debt because of their debt because of their covenants, their debt covenants. So they issue preferreds. So many of the preferreds I studied had bad balance sheets. If you have a bad balance sheet, I won't even look at you. But I was studying the U.S. Bank. It's right in Minneapolis, St. Paul. I was studying the U.S. Bank Annual, and we own it. And I've been following it for 30 years. It's one of the best banks in the world, $485 billion in assets, great bank. And they issued a preferred. And 90% plus of the preferreds that are issued are fixed only. But this was a fixed with an adjustable component because these are perpetual securities. There's no maturity date, which I hate. And they're non-cumulative either. So if they don't pay dividends, they don't become cumulative. But in any case, so I say after I read those two things, I said I'm not interested. But then I saw the coupon was 6.5% in a world of 1% and 2%. So I read further. I saw it was qualified. So the dividends were taxed at cap gains rates far lower than ordinary income. And then I saw it had an adjustable component. When the call date comes, if they don't call it, they have to pay me 3-month LIBOR and 448. So in today's world, they'd have to pay me 7% if they don't call it. So I'm not taking interest rate risk. Whereas if it's a fixed only, you are. If rates go up a lot and you only have a fixed rate, when you go to redeem it, you'll get killed. That can't happen to us. So we started buying these in 2012, 2013, if I recall. We sold all our municipals, all our corporates. So as a result, it's wonderful for our clients now. We are now getting them in many cases, 4, 5, 6, 7, 8, 9% in these fixed adjustables, which in today's world, I mean, they're all banks, so there's industry-specific risk, but we only own one investment bank, and that was JP Morgan. We won't touch Goldman, Morgan Stanley, Barclays, or Citi. And it took us 4 years to buy JP Morgan. During the crisis in 08, 09, JP Morgan was fine. So we own like Wells, Bank of New York, and State Street, which are really custodians. They're not banks. But that's what we've done. And that has really made us heroes in the minds of our clients because we're taking very little risk and we're getting them phenomenal income in a very low return world. Now, it's not a big market. So if you're running 50, 100 billion, you can't buy these. You don't have enough, there's not enough of them. But that's one thing we've done on the fixed income side to really add value to our clients. And on the equity side, we tell them, please be patient. And we have clients, you can't get away with this running a hedge fund or mutual fund. It may take me 6 months, a year to fill that equity portfolio. And if you don't like it, don't give me the money. But think about it. You go to an endowment or a pension fund, and they limit you because they all like to compartment. They don't know what to do with me because we have separate accounts. But you're a small cap value guy. So they say, okay, Paul, you can invest in 1 to 5 billion, all domestic equities, 1 to 5 billion market cap, all value, no growth. If they do, we'll fire you. And here's $100 million, and you have to invest it in 2 weeks. Now, how are you going to beat unless it's March of 09, the fall of 08, August, September, October of 11, January of 16. How are you going to invest that money in 2 weeks and beat your bogeys? It's a joke. It's nonsense. Just buy an index fund and pay 5 basis points or whatever it is, or free now. I mean, is that okay?
Yes, thank you.
Yep.
Thank you for coming in.
pleasure.
You mentioned at the beginning that you don't invest in emerging market economies because you don't think you can, quote unquote, add value. So I was wondering where that assessment comes from and what factors would have to change for you to reevaluate your position.
That's a great idea. And one of the things I wrestled with, which I've never done, it's probably not a bad idea when emerging markets get killed for us to buy a very low-cost index fund to give our clients exposure to it. But I've never done that. If I haven't done the work and know it. The reason I don't invest in emerging markets, China or India, when you think about it, think about every investment you make or what you're going to do. What's your edge? Always think to yourself, what's your edge? So there's an analytical edge. That's really hard to come by. I mean, think about it. If Warren Buffett is looking at financials and I'm looking at him, who are you going to bet on? Okay, so it's really hard on the analytical edge side. There's so many people out there that are smart, many smarter than me. So the analytical edge is really hard. The informational edge, if you do that field-based research, you can get an edge. I don't have that in emerging markets. We don't have feet on the street in India, in China, in Eastern Europe. I can't get the confidence level and the insight level, the differential insights there that I want. Now, if I was really big and had people there, I wouldn't be averse to it. In fact, that would be great. because anomalies, see, the reality is, in the truest sense, you don't want any limitations on where you invest your money other than your insights, the insights, and your knowledge base. So the reality is you want no limitations. The reason you're not investing there is you don't have the insights. But you don't want to be limited by market cap. You don't want to be limited because you're small cap value. What if there's a great growth company and you understand it? You don't want to be limited by geography, by market cap. You don't want to be limited by any of that. And the only way to do that is to have a big enough asset base of high quality clients that give you that freedom. And I think I talked about last time I was here, we had a client and I was a lot smaller. And he was a COO of a company. And he gave me $3 million on December 23rd of 2005. And he's the only client we ever had that we never bought fixed income for. Now we did now because he loves the fixed adjustable preferreds. But he's the only client we ever had that had no fixed income. And I was a lot smaller then. And we didn't have the resources then. We were just trying to survive. And he gave me $3 million December 23rd of 2005. A year later, he calls me. He said, Paul, I was like 40, 50, 60% cash. And I'm charging him 1%. Now we're earning back then more interest in the Schwab Treasury. We were probably earning a little bit more than the fee, but that's it. He said, you're still 50% cash and I'm paying you 1%. You know, cash isn't helping me. I can do that. So I said, if you want to fire me, because I wasn't going to change. And it's not like I predicted 08 or 09. I just couldn't find stuff to buy. So December of 07 comes around, 2 years later. Same phone call. Because he believed in me and stuck with our team, when the fall of 08 came down and the spring of 09, March of 09 came down, we filled that portfolio. You should see that portfolio now. We just donated a stock that we made, I think, 10, 12, 15, 18 times our money onto one of his foundations. Our team could not have done that if he didn't allow us to do what we do. And what would most people have done? They would have had a boss that said, he's going to leave, you got to invest. I don't have to worry about a boss. I am the boss. All I have to do is what I think's best for my clients. So that's another important point, just a side point. My preference, there's exceptions. There's a lot of brilliant people out there. My preference is never give money to anyone, to any firm that isn't owned by the principals, because they have all these biases and all these other things to deal with. We don't. We own the firm. And I think that's a big point. But the major point is, I don't have feet on the street. I don't think I have any advantage to understand the families, the connections, the way things, like in India. I have a friend who's a genius. And 40% of his portfolio is in India. He's probably running $5 billion. No one even knows who he is, and he likes it that way. He's worth an enormous amount of money. He's got 4 or 5 people in India all the time. He goes down there. He has insights that are unbelievable. His track record's extraordinary. So frankly, that's what I would do. If I had a big family, I would give him the money, a portion of their money, and charge almost nothing and let him charge them.
Okay, we're out of time. Here's my last question. What is the most important thing in life and investing you learned over the last 30 years?
In investing?
And life.
And life. I think the most important thing in business is to maintain your integrity and always tell the truth and do the right thing. It's really important, and oftentimes it's hard to do. It might mean foregoing money. It might mean foregoing other things. I think always try to do the right thing and focus on doing the right thing for the client. Second thing I would say is always invert. And whenever we meet with someone, I always put myself in their shoes. And I always like Don Shula's quote. He once said, and believe me, I'm not perfect. I make lots of mistakes. But one of the things Don Shula said was, he really feels good in knowing in his heart, and he goes to church every day. I never go to church anymore, so don't compare me to Don. But one of the things he said was he never knowingly cheated anyone. And I thought that was really, really kind of interesting. So on the investing side, be humble, be flexible, be open-minded, be decisive, attack your own ideas, bring people in that are great, that are humble, and that will attack your ideas and make them better. Don't care where the idea comes from. Remove your ego. It's all nonsense. We don't care about titles. I don't care what you call me. Bill Ruane was a billionaire, and he liked to be called an analyst. He was the CEO and the founder. He could have cared less. He loved being an analyst. So on the investing side, those are some of my thoughts. On the personal side, and this is really important. It's really, really important. On the personal side, anything you achieve professionally, and my family is a perfect example. Even if I was worth $2 trillion, which is 20 times Buffett, it really pales in comparison to my wife and our 4 kids. So, and I'm telling you all, whatever your lifestyle choices are, I could care less what they are. But the point is, really focus on your personal life. And the big lesson in your personal life is really try and find someone, whatever your choices are, that really understands you and you really understand them, and really try and build a life together. So as much as I love what I do, and I really love it, I hope that comes through, there's nothing that compares to my family. And I'm really blessed. I have this extraordinary wife. I have no idea what she's been doing with me for 38 years. She's very tolerant. I'm not easy to be married to. Not that I'm mean or tough around, I'm just never around. But I'm enormously blessed to have a great family. We have 4 great kids, and I get about that much credit for that. She gets all the credit. She's a wonderful human being, and it's really important. The most important decision you're going to make in life, if you end up having a significant other, again, whatever your lifestyle choices are, I could care less. I'm highly liberal. I just don't care. It's none of my business. But the point is, really take your time and try to pick the right person. It's really important. And don't lie to yourself. Most people in life, they settle. They settle professionally and they settle personally. And don't settle. Life's really too short. That's it.